Has the tech bubble burst and we're heading to a recession right now? Some people in my Snake Pit Telegram, which by the way you can find the link in the video description below, have asked that question or wondered, are we heading into a recession right now? You know, my video last night talked about the pump and dump into a recession and how typically markets are very bullish around rate cuts or even sometimes slightly after rate cuts. But we have to also consider the alternative case, and that is the case of a recessionary bear market materializing now, resulting in a hard landing sometime within the next 12 to 18 months if we follow the average time span of a recession. So I think it would be irresponsible not to consider this case. So that's what we're going to do, and you can see what I have pulled up over here on the chart. I've got Nvidia, and if you know anything, Nvidia has had a very, very rough day today, or actually rough yesterday, since today is the 4th. They had an antitrust lawsuit filed against them by the U.S. Department of Justice, and so this is not a good thing for the biggest driver of the tech bubble and of the stock of the S&P. So whatever happens to Nvidia certainly does not spell good things for kind of the collateral effect. So this is crypto simulation theory. I am the Gaussian snake, and I encourage you to like and subscribe to this channel if you want more content like what I'm about to deliver tonight. And please be sure to join me in my free Telegram group, the Snake Pit. None of the thing in here is going to be financial advice. These are just theories. Tonight I'm going to look at the case that we could be in a recession right now or rolling over into one and possibly not get that pump into rate cuts that we so typically do get. If you look at the Nvidia chart, you can see that things don't look so hot right now. We just formed a lower high on the weekly time frame, and we're rolling over again. We've just about hit this Gooner EMA line, and the Gooner EMA line is basically, think of this as a bull market support band, and when price falls beneath here and stays underneath here, that's generally not a good thing. The Gaussian channel looks like it may be in the process of inflecting back to concave down pretty soon as well. So if we also look at the Snabble RSI for Nvidia, we can see it's been kind of in a downtrend. Maybe we're going to head a little bit lower, but you know, this is a weekly time frame. I think when if we start to get down into these levels, you know, I would anticipate some kind of balance occurring. The question is, will it just be another lower high, or could Nvidia have some life left in it? You know, also looking at the MACD, or moving average convergence divergence, we can see that you know, Nvidia did have a bearish cross and a bearish divergence occur in July, and so for, you know, just over a month, Nvidia has been kind of slogging through the mud. So that remains to be seen exactly what's going to happen with Nvidia, but that's just one kind of point for the bears right now, is that yeah, the biggest tech stock in the stock market is rolling over, and that certainly is not a very promising sign for a bullish quarter 4 for the stock market. We also don't want to overreact to this, but there's some other things that are concerning that I want to point out as well. Again, my base case for the crypto market, at least, I'm talking about the stock market right now, but for the crypto market, is a pump into rate cuts and or around rate cuts and a bullish quarter 4, potentially a bullish quarter 1 for maybe the altcoin market, and then a rollover into a recession then. But however, I think it's important to also consider the case that we could already be heading into one. That's kind of what I was trying to say at the beginning of this video. So this is not my base case. It could very well turn into my base case if the data confirms it. So let's go ahead and take a look at some other concerning signs. This chart represents the reverse carry trade. We know that the Bank of Japan surprisingly raised their interest rates, which ended up causing a lot of very heavy investors to get margin called, and you're starting to see the unwind of the carry trade. Or I should say the unwind of the reverse carry trade. And, you know, looking at it from a technical standpoint, folks, it doesn't look good. I had a bullish cross on the Gooner EMA, and we generally don't like to see this get bullish, right? We like to see this be bearish. And a rallying above the median line of the Gaussian channel. I mean, this is set for a pretty nice breakout. Last time that happened, if we go back to, let's go back to 2007. You know, remember the housing market and everything that was going on and the financial collapse. Look at this. The last time that, you know, we had a unwind of the reverse carry trade, look what happened next, right? we entered into the we know this is the timing of the great financial crisis, okay? Uh, Not pretty, folks. Not pretty when this happens. So, yeah. And then, this is the carry trade. The carry trade has been going on for quite some time. There have been some instances. This was a scare in 2016. We've had a few little scares here and there, but I have to tell you, things don't look too good right now. If this starts, look at the slope. This is an insane rate of change right here. I mean, it is just firing off towards the top of the channel, and I think this is going to break out. And that's not good news for all the people that will likely get margin called, So this is definitely something that we need to watch out for. One of many things that just aren't looking so hot right now. And I'm not even talking about unemployment. I mean, that data is coming in later. I'm just focusing on a few charts here, and then I want to transition to Bitcoin. US oil is a little bit of a hard read. It's just been going sideways for a few months after breaking down from this double top over here. Looking at the RSI, the Snabble RSI, and the MACD, it is possible that US oil is going to find a bottom pretty soon, and we know what happens if this goes back up. That's not good for inflation, but at least right now it's heading down. We are getting pretty close to being fairly, at least on a weekly time frame, with U.S. oil futures. I think we're getting close to being, well, we actually technically already are oversold. So there may be a little bit of a bottoming process happening here. The Gaussian Channel is green, indicating this is just mostly sideways movement with a slightly bullish bias. So yeah, that's another thing we have to really watch out for. US dollar index is on the verge of an inverse head and shoulders on its Snabble RSI. It already went to extreme oversold territory, and you can see light pinks printing, potential cross coming. So that's not great either for risk assets if that materializes. Now, gold has had quite a nice run since October of 2022. It's been in a bull market. And, the Snabble RSI looks really good. It looks like it's getting a little heavy here. And we might come in to test the Gooner EMA line fairly soon. But just the fact that gold is in a bull market, not good, right? People are going to gold for a good reason. Based on what's been happening in the market today, look at how these probabilities have shifted from the video that I did last night. Last night it was, and honestly for the past several weeks, a 25 basis point cut seemed to be baked in. Notice what's happening to the 50 basis point cut. That's rising to 43%. That does concern me because, if we get a 50 basis point cut as our first rate cut, that's generally not a good thing. That's saying something is wrong with the economy. I mean, there is something wrong with the economy, no doubt. If we pull up the probabilities, I'm not sure how well you can see this. Let me see if I can make it just a little bit bigger for you. You can see that if we don't get this is a little bit scary, right? So in September, market is still favoring a 25 basis point rate cut. We'll see though. We'll see. We've got about 2 weeks, exactly 2 weeks till the FOMC meeting, and everybody is waiting for this one. Then the market is baking in a 50 basis point rate cut for November, and then 25 basis point rate cuts laddering all the way down to May, hold steady for a couple months, and I'm guessing they're thinking maybe the final cut is in September. And this presents somewhat of a soft landing scenario, but I am starting to see the hard landing components find their way in here, right? So aggressive rate cuts are generally not a sign of confidence in the market. And just seeing this target here move around so close to September 18th does concern me. The market is starting to sort of think maybe things are worse than we think they are. Yeah, I think they are. Folks, the unemployment rate, we don't know what it is yet, but it had a bullish cross on its Gooner EMA back in July. And it is approaching a red concave down, potentially inflecting Gaussian channel. Last time this happened, we went into a recession. Wow, look at that. Look at the Snabble RSI right into the hot zone. Look at this too. We've got dark green candles. Wow, this is one of the most bullish looking charts out there right now is unemployment. So that's not good, right? That's not good. And if we look at Bitcoin itself, we can see that it is on the verge right here of printing a bearish cross on its Gooner EMA. And the last time this happened was back here in September of 2023, just a year ago, on September 18th of all days. That bearish cross was quickly invalidated. And then we had our, our bull market, if you want to call it that. I mean, this is technically a bull market, okay? I don't even want to like acknowledge it myself because I feel like, gosh, what a pathetic pump that was. Like after, hitting 69K nearly, almost 3 years ago, this is the best that we could do. Like surely there's more life left in the bull market, but what you're seeing is you had this parabolic pump and it's just been dumping ever since. Also, the Gaussian channel is starting to turn down. It's starting to go concave down, and this is a lagging, statistical indicator. The widening just indicates increasing volatility, but you don't generally like to see this, right? We've already tested the channel. It looks like we might be coming down to test it again. That would be at around 53,000. If we come way down and test the median line, I mean, that's 45K. All that's kind of within my, within a reasonable case for me where we could hit those levels and be just fine as long as we bounce off the median line. But if we don't and we slice through it, then we've got a problem. Then we're likely heading into something much worse for the broader market. If you want to look at what happened last time we had a recession, there's only one instance of it with Bitcoin. This is basically what took place. So you had your Gaussian channel, green and concave up. This is in 2019. The rate cuts. I'm going to overlay the interest rates with the stock market and go through that again. I've done this in several of my videos. I think it's good to see repetitively. If anything, it just gives you some renewed perspective. We had a bearish cross in November of 2019. And that bearish cross produced a testing of the median line of the Gaussian channel for quite some time. I mean, this happened for months. And then a bounce, right? Then a bounce and a straight up dump, a pump and a dump. And, this is kind of my base case for what I think is likely to happen this time around, just not in exactly the same way. I still think personally that we're going to get a pump and dump, but the way that it's going to play out may not be exactly the same as it did in 2019. But we did have a bearish cross back then. We had a concave down Gaussian channel. We rode the Gaussian channel. We maintained it as support. And that allowed us to rally one last time before we had like a 70% drop, or whatever this was, straight to the bottom. And another bearish cross. And then it took a while to get back up and form another bullish cross. And that was a fairly quick recession, but I think that you can get an idea of what Bitcoin will behave like in a recession by looking at how it did behave in a recession. Okay, this was near a rate cut floor. So, yeah, I mean, like one potential situation, that could happen here, right? And I know I'm supposed to be a little more bearish than this, right? Because I'm trying to talk about what if a recession happens now. But, we could head down. And, it could happen fairly quickly. Like we could spill over very quickly, maybe like right around rate cuts and we're hitting a price of like 47K or something, and maybe we do what we did in 2019, which is kind of ride this for a little while and then blast off to our leg up, and maybe it's a whole quarter up. Maybe that's where we hit like, 100K plus. I don't know. That's the bull case. Okay. I love the bull case. I really want to be bullish right now. All right, that's my pump and dump case. But what if that doesn't happen? And instead, we just kind of go down. I think there will be a battle at the median line. There always is. And what if we go down even more, battle this line, maybe try to come up for air, and we start heading down from there? That is, something that is possible. I'd like to think that's not going to happen. I don't really see that as being the most likely path forward, but I just gave you a lot of data that is very troubling about the broader market. Watching Nvidia crash is not a great thing. So I think Nvidia is going to have some nice bounces, though. I don't think it's just going to go straight down. As to how much this market could actually handle, I mean, we'll see. So what's going to happen with Bitcoin? What is the most likely path going forward? And if we did get a recession, like right around now, let's say that we were front running a recession, how would we know that? Like, is there evidence in the stock market that something like this has happened before? And can we find that evidence? Can we just kind of get a better idea of what to expect? And that's kind of what I want to explore next. So I want to acknowledge where the S&P is right now as of today. It still looks okay, right? So its Gaussian channel on the weekly is concave up and narrow. You want to see that. It does look like we're putting in a lower high or double top, which that's not great if that's what this turns out to be. But we are finding support at the Gooner EMA bull market support band. So, still very bullish. It is narrowing, but it's bullish. So that is a positive sign. I just want to at least acknowledge that, okay, before we go back in history. So we're going to do a little bit of a historical run through of different rate cutting scenarios. We know where rates are right now, so I mean, there's no point in putting them on the screen when we're in looking at 2024. But let's go back to like the COVID recession. We'll go back to the Great Financial Crisis. We'll go back to .com, and we'll even go back a little bit before that and take a look at how the stock market behaved, specifically heading into rate cuts. And we've done this before. This is not like the first time I've done this, but we'll also look at the Gooner EMA. We'll look at the Gaussian Channel, maybe even pull up other indicators if we feel like it. I don't want to make this too convoluted though. So we can kind of see if maybe there's a pattern that we might identify for the likely behavior of the stock market. Because honestly, whatever the stock market does, I mean, if the stock market just kind of chops and goes sideways for a little while, that could actually be really good for Bitcoin. But if the stock market rolls over and tumbles down, Bitcoin's going to get wrecked. I mean, there's no way Bitcoin comes out okay in that situation. So I have to say, like, for those of you who think we're heading into a bear market right now, I don't see it yet. Okay, I don't see it yet on this chart. But that doesn't mean it's not going to happen. So let's go back to the COVID recession and throw up the federal funds rate on the screen and see kind of how the market behaved from the first cut to the rate cut floor and when the tumbling really started. Okay, so this is COVID, right? This is the COVID recession. And you can see that the market, once we reached a terminal rate, more or less up here, it was kind of just floating around 2.4%. What happened on our first cut? Well, notice how the stock market was actually looking kind of similar, right? You see, you had like a bullish Gooner EMA, and it was getting kind of narrow. The Gaussian channel did not look as good as it looks today. That first cut was fairly aggressive, and the market, let's see exactly what happened here. The market dumped a little bit. Okay, it did. Kind of went sideways as rates went down to about 1.84%, and at that point the market rallied. So the market rallied after the first rate cut, okay, and it had a nice rally for several months until February of 2020, and then we got our recession, okay. And so this has kind of been my base case, is something like this would play out for Bitcoin, where Bitcoin would have a nice rally into the end of the year or into early next year, and then dump out. I don't think it will dump like this though. I think it's going to be a slower process. That's at least what I think. Okay, so what happened in 2019 heading into 2020 shows that the stock market can pump after rate cuts, even if it dumps a little or goes sideways for a little bit of a while. And this was very unprecedented, because look at how aggressively the Fed cut. The Fed cut so aggressively that we just slammed straight through the Gaussian channel, inflected it, but then we had this V-shaped recovery and bull market was back on. So this is, to me, maybe a little atypical of an example. I think something more like .com might be better to look at, but I think we should look at several and just study them and kind of see what was going on at the time. Okay, so this is the stock market in 2006 and 2007, heading into one of the worst recessions in modern history. I'm going to actually take this line off here. So what happened is we had our rate cut ceiling here at a similar level to where we are today. We're just a little higher than this now. And if we look at what the stock market was doing, we just zoom in a little bit on it. Okay. I wanted to try to capture the entire movement. But if we look at what was happening at the time, we had a bullish cross on our Gooner EMA in August 2006. Okay, and we rode this bull market support band. with some tests along the way. And I mean, it almost looked like we were going to fail it here, but the Gaussian channel median line saved us. And then we had a final pump. See, the dump happened on actually the first rate cut. This is kind of interesting. And it was a very small rate cut. The market, I guess, didn't like that. And the market took a little tumble. And we had another very minor rate cut. And then the market is like, oh, we're cutting rates. Okay. Like, we're actually cutting rates. And with a few more rate cuts, we put in a new all-time high for the stock market. Okay. And this was in October of 2007. And you know what happened next. It was just, tumble, tumble, tumble. We sliced through the Gaussian channel. That is sort of your warning, get out now sign if that happens. Dead cat bounce. Rates were held relatively flat. And you can see this became very violent for the market. Okay. The GFC is an exceptionally bad event for the markets, and we tend to not see these happen too often. But rates made it all the way down to zero. Okay, that's how bad things got. And right at that, it wasn't even right at zero, but it was as we were getting closer to the terminal rate cut, that's when the stock market really started to hemorrhage. And we got a bounce finally. The bear market was over in March of 2009, and we started to recover. We put a bullish cross in, and then we went on to another long-term bull market. Okay. So in this situation, we still had a rally. Not necessarily, we did have a rally into rate cuts. Like, we had a rally into rate cuts, and then we had a dump right on the rate cut, and then we had a rally afterwards that didn't really last for that long. I mean, it only lasted a few weeks. So that's something we should consider. Okay, that did happen. Honestly, the conditions now look a little bit more bullish in terms of just how things look. But yeah, it could happen. Okay, here is .com. All right, so .com, we're going to zoom in on it and really see what was going on. All right, so what was the Gooner EMA doing? Again, that's my bull market support band. Okay, so had a bullish cross in October of 1999, and we had, kind of struggling to maintain this Gooner EMA, right? And then this is a situation where, here we are in September of 2000. The Gooner EMA was still bullish, and we had a bearish cross in October, okay? We had a bearish cross in October. The recession was already underway. So something like this could happen. It could happen. And then the rate cuts didn't make a damn of a difference. Like, it just didn't matter at all. Like, we just kept dumping and dumping and dumping and dumping until finally, we reached what we thought was a terminal rate of about 1.71, but nope, got to cut some more. And the market didn't bottom for quite some time. Like, the market bottomed when we were only near our terminal rate, okay, which was near, we got interest rates down to like 1%. Okay, so we got arguably a triple bottom here, which is very bullish. We got our bullish cross, and we had our next bull market. Okay, so this is a situation that could happen, right? We could already be dumping into our recession. It's possible. The Gaussian channel was already starting to get pretty fat, though, indicating there was look at all this volatility. And if you look at what's happening today, we don't see nearly as much volatility as we did back then. Let me see if I can kind of overlay the two for you so you can see today and what happened back then. Okay, I want you to notice the difference. Down here is where the S&P is at currently, and I think I'm going to keep this here for now. We can actually revisit the previous recessions because it's really a useful comparison tool. So you can see what happened in the .com. Look at the Gaussian channel. It didn't look very good already as we were heading into the rate cutting cycle. Yeah, it's not how it looks today. Look at that tightness. I just can't see it. I can't see the recession coming right now. I think it's going to be delayed. And then, like I said, I'm addressing the case, okay, for people who think we're heading into one. Like right now, I just don't see it. This was the GFC. Okay, we had a green Gaussian, but look at how it was starting to fatten and turn concave down, and it doesn't look like that. It just doesn't. What about COVID? Let's go back to the COVID drop. I should have done this the first time around, but you know, it's all good. COVID drop. How'd the Gaussian channel look then too? I mean, I feel like our Gaussian channel on the stock market looks better than any of these times. Probably most similar to COVID though, like out of anything. Like you had just come out of a little period of red and you were starting to trend up and starting to narrow, but honestly, we even look better than COVID. So we've already looked at the GFC, we've looked at .com, and we've looked at COVID. So let's go back even more to other recessions. Now here is a similar looking chart, okay? The Gulf War recession. This is a similar looking chart in my opinion. So we had a rate cut ceiling around 9.91%. Imagine those interest rates and how those felt. I was alive during this time, but I was in the process of late childhood, we could say. Okay, so yeah, interest rates were held steady, and you can see we got our first real substantial cut came in May of '89. Market dumped a little bit into the Gooner EMA band, but look at this beautiful Gaussian channel. It looks even better than what we have now, but very similar, tight and concave up. And then we started getting this series of really nice rate cuts. And even in this situation, throughout these rate cuts, look what the stock market was doing. I mean, it just kept running. First rate cut happened in May of '89, and the stock market kind of rolled over a little bit until it hit its Gaussian channel in April of 1990. So that's quite a few months, and it bounced up again. It bounced up again, and it just these rate cuts were so gradual. See, this is kind of an ideal situation for the market, and we bottomed like around what, a year and a half later in October 1990, while the rates were still being cut, and they just kept getting cut and cut and cut. And actually, because the cuts were so gradual, it stimulated the economy and led to another bull run. Okay, this is how you cut rates. Like, this is the way to do it. And that's honestly how things look right now. So, if we're kind of following along with the 1991 Gulf War recession, then this doesn't really look that bad, guys. Like, it looks like, I mean, of course, nothing's ever going to play out the same. They didn't hold rates this high for that long back then. But the Gooner EMA right now, the Gooner EMA back then, they look very similar. So this is the most, and look at, we're coming off of a red Gaussian channel, just like here, coming off a red Gaussian channel. And look at this dump in, like, you can't make this up. The fractals from the Gulf War recession and now just look so freaking similar. The difference, of course, were the interest rates. They weren't held high for as long. It was a very gradual rise and a very gradual fall, whereas here it's just been steady. Obviously, that's going to affect the market differently. God, if a situation like this played out, my goodness, I mean, so you would get a really nasty drop in this, so let's see, we were in, first rate cut happened in May. Your first truly nasty drop, I think, for crypto, it would kind of be a nasty drop, would have been about half a year later. This is like, this is the pump, the dump, and then the pump again, and then the dump again, and then pump again. This dump would be really nasty for crypto. Like this started in July of 1990 and really only reemerged about half a year later, but we could handle this. I mean, I don't think crypto would get totally destroyed in this situation. I actually think it would actually be pretty good for the market if this is kind of how things played out. And that's the closest situation I found so far. So, yay, that looks good. So the conditions align the best right now with the Gulf War recession. Let's go back to the 1980s and take a look there. Okay, by the 1980s, I mean, interest rates have gotten completely out of control. They kind of had to, I mean, Paul Volcker just started to raise rates like crazy, had to combat inflation because inflation just wasn't getting under control in the 70s. And you can see the market was all over the place. So, we had interest rates at 17, 18. These are insane interest rates. Federal, I mean, 18%, right? And we had a very aggressive drop. And it seems like whenever cuts are done aggressively like this, Generally, the market doesn't really seem to like it very much at first. But what's interesting is here, it looks like the market topped right before the last rate hike, actually. And, oh, actually on the cut, never mind. The cut was a bullish signal, and then it just pumped really nicely. And we got to get the job done, right? That didn't get the job done. Cut again, and the market did not like it that time. And then we raised the rates again. Market just kind of went sideways into the Gaussian channel. And then finally we got a proper recession, and the market bottomed before the last cut because we were cutting from just such a high point, and kind of similar to what happened in the late 90s, right? So this is similar phenomenon to the late 90s. It looks nothing like what we're going through now, like nothing at all. Yeah, I'm going to skip over some recessions, kind of focus on the real big ones in the 70s. So 70s saw like a decade of sideways movement, and inflation just kept coming back. So you can see that, I don't even know, let's just focus here in the early 70s. Well, let's focus on this recession. This was one of the worst ones. And you can see, after achieving a bottom in 1970, market rallied, S&P did its thing, bullish cross. Is that a bullish cross? This looks like a bullish cross. Bullish cross in 1970, then a whole series of bear bull, just all over the place. Tested the bottom of the Gaussian channel, but recovered. So interest rates at that time. Let's see if I can just kind of adjust this here somewhat. There we go. I'm trying to pull it up, but it's just, yeah. So this is kind of an interesting situation over here. The market actually started to dump as rates were rising. This is just the effect of inflation killing the economy in the 70s. So market just already started to dump. The Gaussian channel did look fairly clean, but it was kind of wobbly. So maybe we should just zoom in and kind of get a better grasp of what was going on at that time. This was with rate hikes, so that again is nothing like with what's going on now. And some of these rate hikes were very aggressive and broke the market. And it was actually, the rate cuts was just too late. It's too late to save a failing economy. And we got our bottom as rates were being cut, and then a higher low close to the rate cut floor, and then we had a bullish cross, and we entered into a short bull market. Okay, before that, so yeah, it doesn't really look like our current situation. Really only found one that does, and that's the Gulf War recession. This one doesn't really look like it either. I mean, to be completely honest, very wobbly Gaussian channel. This test is similar to like this test here. Rates were going up, right? And they went up and up and up, and again broke the market. This is just inflation, no other way to put it. And the market crashed on rate cuts. It was just too late. And it was near a rate cut floor, the market really started to turn bullish again. Okay? So, yeah, this is a soft landing situation where we avoided, we still had a drop, right? But the rate cuts actually, were great for the market. That was an unusual situation, unusual circumstance. I'm not really finding any data that looks quite like what we're going through now. Maybe this period in the early 60s, okay? So maybe like right here. But even here, interest rates were already pretty low, so you can't really compare this. This was rate hiking cycle, not cutting. I don't even know if I want to go back any further, honestly. I don't see the point to it. Okay. So the recession that looks the most similar, or the time period, we can't really call what we're in a recession right now. The time period that looks the most similar to where we are now is the 90s. Specifically, 1990 to 1991. And so, I have to think to myself that it's really, not all that bad if we had something like this play out. What if we don't get aggressive rate cuts? And, we should anticipate downside and upside volatility. But honestly, this makes me even more optimistic than anything else. Yeah, you can't really go back in history and completely compare two different times, but I can look at two charts and say they look fairly similar. like up to a point. Like I think if you were to compare, these two charts, like September of 2024 looks kind of similar what's going on now to maybe October, November of 1989. And the drop just wasn't that bad. Like, let's take a measured move. This stock market drop, let's see, 168 days to drop. What is that? 168 days is like 5 months, 6 months. So, and this started when? It started in, like the real drop started in, gosh, I can't see. I need to take this off. Started in July of 1990 and ended just 4 months later or 5 months later. So that would be a wonderful outcome. I mean, it doesn't have to play out the same way, but just look how similar these charts look. Like, I just can't get over it. Like, even if we drag this back, look at how similar the late 80s look, minus the interest rates being insanely high. There's quite a bit of similarity between the late 80s and the, what do you want to call it, the late 2010s heading into 2020. A lot of similarities, right? Quite a bit. We had a nice, healthy bull market kind of going on here. And the market can take decades to truly unwind into like these really nasty recessions. And I've studied them, like it's about once every 30 to 40 years that we get a truly catastrophic recession like the GFC. So it's going to be hard to know exactly what the crypto market is likely to do, right? Like, but this is the most similar looking fractal and technicals that I have. I mean, let's see if we can throw some indicators up without cluttering this chart too much. Just some simple ones, like maybe like the Snabble RSI, for instance. Okay, so here's the Snabble RSI for the time period of interest. We'll try to drag it out so we can get like, some better looking data. And then we'll pull up Snabble on here too. This is really fascinating. I absolutely love doing this. This is why I love doing what I do. Look at the similar pattern in the Snabble RSI. Look at it. So similar. Wow. Okay, so we got a lot to talk about. I just wanted to take a look at one other thing, the unemployment rate from back then and now. So, I mean, other than this COVID spike that we had, look at how similar this looks. Like if you just take away the COVID spike, it's like unemployment was leveling out, and this is almost like an anomaly. And you could almost imagine it kind of slowly curling back up. The rate of change seems a little bit similar to what happened in the late 90s. There's that bullish cross that happened in August of 1990. So what if July of 2024? What if July of 2024 sort of is kind of like August of 1990? Then, unemployment peaked in June of 1992. So it took a while, but the market recovered even before this peak. Okay, and then unemployment kind of topped out and started to fall. So what if we see a rise and maybe we get up to levels, we could put in a lower high, maybe we're like here at like 8 or 9%. Like I don't really know what the support lines are for unemployment, so this would be kind of hard to measure. But what if we do head up in, maybe like to a similar like 7 and 8% unemployment? I don't think that this recession has to be catastrophic like everybody's thinking it's going to be. It could actually end up being shorter and less nasty, which is not what we're really expecting. But how often does the market live up to our expectations? Not often. So this definitely gives us a lot to think about. So what do you think? Do you think that the Gulf War recession, a situation like that is likely to be kind of the situation that plays out based sheerly on technicals. Because narrative always follows price action, not the other way around. If that's the case, man, our bull market could actually go on longer than what we think. And this brings me back to my original pump and dump video that I did before the one I did last night. All I'm doing here is just looking at the market from different perspectives, digging deeper and deeper into the data. And if you're watching all these videos, you're going to be learning so much, and you can start to really get kind of a better feel for things and not maybe feel such extreme fear like a lot of people are feeling right now. The stock market heading into this probable recession looks the best it's looked since the what do we say? Like it was around late 80s, early 90s. Okay, late 80s, early 90s, and it's hard to feel that bullishness right now when Nvidia is rolling over and everything is just this big pile of uncertainty. And we also know that markets won't play out exactly the same way as they do. But we can look at the Gaussian channel. We can look at things like RSI, MACD, and if we see similar trends playing out, then we can at least suspect that the recession might play out in a somewhat similar way as well. Okay. We have had rate cuts from much higher rates than where we're at now and had, not the most violent recessions. So, wow, this video really humbled me, like doing it and just doing like the most thorough analysis I feel like I've ever done on the stock market and comparing it against the federal funds rate and just looking at Gaussian channel similarities, Gooner EMA similarities. And when you take all of that together, our stock market looks really good right now. And it almost looks like it's not going to roll over in this like massive hard landing. And so that kind of has me thinking, well, then what about crypto? What about Bitcoin? Could the bull run go all the way through 2025? And I think, yes, it could, with interruptions along the way. There will be interruptions if we follow the Gulf War recession, something kind of like it. And again, we have to be careful not to assume the present has to play out exactly the same as the past, because we're not in the Gulf War times right now. Like things are different now than they were back then. I don't remember what inflation was back then either, and I'm not going to go look it up right now, because the point of this video is not to give you a prediction that's going to definitely come true. It's just present you with another perspective. Ultimately, you, the viewer of this video, has to decide for yourself what you think is going to happen, or if what happens even matters. I think having a plan is what matters the most, and these videos can help you formulate one, but it's your ability to execute that plan that really matters. So I don't think we need to be all doom and gloom heading into rate cuts. As we've seen from looking at the S&P over multiple rate cutting cycles, the Gaussian channel tends to look kind of ugly when the S&P bleeds into rate cuts. The Gaussian channel now looks so similar to the 1990s, the early 1990s Gulf War. Before the Gulf War recession, we actually had a fairly nice pump. There were some trouble spots along the way, but the dump didn't happen until much later. And it wasn't even that bad. It was like 5 or 6 months of down. It's a really short recessionary bear market if we get something like that. And that actually aligns pretty well, like I said, with my original video, which is where I said, and this is not the, in fact, I'm going to link that video to the end of this one, which is coming soon. Okay, we're almost done here. But it aligns really well with the idea that we would, have a little bit of a dump now, then a pump into rate cuts, and then the stock market would continue to be in a bull market for another few months into quarter 1. Then we would get a dump, and then that dump could last for who knows how long, maybe a few months, and then we could see a pump afterwards. So we could have kind of a bull market that gets like interrupted by a hard landing that doesn't have to be super dramatic, right? And then we could just that's sort of what this video makes me feel like. Every video I do, I feel like I get a deeper and deeper understanding of what's going on. And this one really provided me with a lot of reassurance that maybe things aren't as bad as they seem. What do you think? Let me know. Let me know in the comments. Drop me some comments. Come over to my Snake Pit Telegram. Again, the link's in the video description. If you have a Telegram, we have about like 270 people there. And I've been running this group since like around, I think, January, February-ish of this year. We've grown a lot in that time. We have a very tight-knit group, and we would love to welcome you in. And we have some very experienced veteran traders who share words of wisdom. They share their techniques and strategies, and you will get a whole multitude of perspectives while you're there. So be sure to join that. Like and comment, like I said, if you enjoyed this video. Also subscribe to my channel if you want more videos like this. If you like the really deep, in-depth, mathematical, data-driven analyses, then you're in the right place. That's what crypto simulation theory is all about. And the Gaussian snake is modeled after the Gaussian channel. And the Gaussian channel is one of my favorite indicators, if you couldn't tell. It tells you a lot about market momentum. Very useful for the stock market. So with that, I think we'll wrap it up there. Thank you for joining me for another video, and I'll see you in my Telegram channel. Come stop by, say hi. All right, bye.